Inflation, the persistent rise in the general price level of goods and services, remains one of the most closely watched indicators in modern economies. When inflation accelerates beyond a manageable pace, it erodes purchasing power, distorts investment decisions, and can destabilize entire economies if left unchecked. Therefore, understanding the mechanisms through which inflation can be brought down is critical for policymakers, businesses, and households alike. The process is multifaceted, involving a mix of monetary policy, fiscal discipline, supply-side reforms, and the management of expectations. Each of these levers interacts with the others, forming a complex web of cause and effect that ultimately determines the path of inflation. At the heart of inflation control lies monetary policy, wielded by central banks as their primary tool. Central banks, such as the Federal Reserve in the United States or the European Central Bank in the Eurozone, are tasked with maintaining price stability. Their most potent weapon against inflation is the manipulation of short-term interest rates. In periods of high inflation, central banks typically raise policy interest rates, making borrowing more expensive and saving more attractive. This tightening of monetary policy reduces the amount of money circulating in the economy, as consumers and businesses cut back on spending and investment due to higher borrowing costs. As demand cools, upward pressure on prices subsides, helping to bring inflation down. The transmission of monetary policy to real economic activity is not instantaneous. When central banks raise interest rates, the effects ripple through the financial system over time. Higher rates increase the cost of loans for households, leading to reduced consumption, especially for big-ticket items like houses and cars. Businesses also face higher financing costs, which can dampen investment in new projects or expansion. The cumulative effect is a slowdown in aggregate demand, which, all else equal, helps to moderate price increases. Moreover, higher interest rates tend to strengthen the domestic currency, as foreign investors seek higher returns, further dampening imported inflation by making foreign goods cheaper. However, monetary policy tightening is not without its risks and limitations. If rates are raised too aggressively or for too long, the economy can tip into recession, resulting in job losses and lower incomes. Policymakers must therefore strike a delicate balance, calibrating their actions to ensure that inflation comes down without causing undue harm to economic growth. Furthermore, the effectiveness of monetary tightening depends on the credibility and independence of the central bank. If markets and the public believe that the central bank is committed to fighting inflation, their expectations adjust accordingly, making the policy more effective. Fiscal policy, managed by governments, plays a complementary role in controlling inflation. Fiscal discipline refers to the prudent management of government spending and taxation. When inflation is high, governments can reduce aggregate demand by cutting public expenditure or increasing taxes. By withdrawing fiscal stimulus, the government lessens the overall demand in the economy, reinforcing the dampening effect of tighter monetary policy. For example, reducing subsidies, delaying infrastructure projects, or tightening eligibility for social programs can free up resources and reduce inflationary pressures. Tax increases, while politically challenging, can also play a role in curbing inflation. Higher taxes reduce disposable income for households and profits for businesses, leading to lower consumption and investment. However, the design and implementation of fiscal measures require careful consideration. Sudden or poorly targeted spending cuts or tax hikes can disproportionately affect vulnerable groups or stifle productive investment, potentially undermining long-term growth prospects. Ideally, fiscal consolidation should be gradual and accompanied by structural reforms that enhance the efficiency of public spending. In some cases, a lack of fiscal discipline can undermine efforts to bring inflation down. If governments continue to run large deficits during periods of high inflation, they risk fueling further price increases by injecting more money into the economy. This scenario can create a vicious cycle, where monetary policy tightening is offset by loose fiscal policy, rendering both less effective. Consequently, coordination between monetary and fiscal authorities is essential to ensure a coherent approach to inflation control. While monetary and fiscal policies primarily address the demand side of the economy, supply-side factors can also play a significant role in driving inflation. Supply-side policies are designed to improve the productive capacity of the economy, increase efficiency, and reduce costs. These measures can have a lasting impact on inflation by addressing bottlenecks and enhancing competition. For instance, investing in infrastructure, streamlining regulations, and promoting innovation can boost productivity and lower the cost of goods and services over time. Labor market reforms, such as improving education and training or making it easier for workers to move between jobs, can help reduce structural unemployment and wage pressures. Similarly, policies that encourage competition, such as breaking up monopolies or opening up markets to foreign entrants, can drive down prices by giving consumers more choices and forcing firms to operate more efficiently. In sectors where supply constraints are acute, such as housing or energy, targeted interventions to increase supply can directly alleviate upward pressure on prices. Supply-side policies often take longer to yield results compared to demand-side measures, but their effects are more durable. By raising the economy's potential output, they help ensure that growth can proceed without igniting inflation. Moreover, supply-side improvements can make economies more resilient to external shocks, such as spikes in oil prices or disruptions to global supply chains, which have been prominent sources of inflation in recent years. Another crucial yet sometimes overlooked element in the battle against inflation is the management of expectations. Inflation is not just a mechanical process driven by current economic conditions. It is also shaped by what people believe will happen in the future. If households and businesses expect prices to keep rising rapidly, they may act in ways that make those expectations self-fulfilling. Workers may demand higher wages to keep up with anticipated price increases, and firms may preemptively raise prices to cover expected cost hikes, creating a feedback loop that perpetuates inflation. Central banks and governments can influence these expectations through clear and consistent communication of their commitment to price stability. By setting explicit inflation targets and explaining the rationale behind policy decisions, authorities can anchor expectations and prevent inflation from becoming entrenched. Credibility is key. If the public trusts that policymakers will do what is necessary to bring inflation down, their expectations adjust accordingly, making it easier to achieve the desired outcome. Conversely, if credibility is lacking, even aggressive policy measures may fail to convince markets and the public, making the task much harder. Forward guidance, a tool increasingly used by central banks, involves providing information about the likely future path of policy rates or other instruments. By signaling their intentions, central banks can shape market expectations and influence behavior in the present. For example, if the central bank signals that it will keep interest rates elevated until inflation is firmly under control, businesses and consumers may delay price and wage increases, helping to break the cycle of rising inflation. Managing expectations also involves being transparent about the trade-offs and uncertainties inherent in policy decisions. Inflation is influenced by a wide range of factors, many of which are beyond the direct control of policymakers, such as global commodity prices or geopolitical events. By acknowledging these challenges and outlining contingency plans, authorities can build trust and maintain credibility even in uncertain times. It is important to recognize that bringing inflation down is rarely a smooth or painless process. The interplay between monetary policy, fiscal discipline, supply-side reforms, and expectation management creates a dynamic environment where outcomes are influenced by both domestic and global developments. For example, a surge in oil prices due to geopolitical tensions can push up inflation even as domestic demand is cooling. Similarly, supply chain disruptions or labor shortages can complicate the task of policymakers, requiring flexible and adaptive responses. In recent years, the COVID-19 pandemic provided a stark illustration of these complexities. Lockdowns and restrictions disrupted global supply chains, leading to shortages and higher prices for a wide range of goods. At the same time, massive fiscal and monetary stimulus boosted demand, amplifying inflationary pressures. As economies reopened, central banks faced the challenge of tightening policy without derailing the recovery, while governments grappled with the need to withdraw support measures in a way that did not exacerbate social or economic dislocation. The experience of the 1970s and early 1980s offers another valuable lesson. During this period, advanced economies experienced a prolonged bout of high inflation, driven by oil shocks and accommodative policies. It took a determined effort by central banks, led by the U.S. Federal Reserve under Paul Volcker, to finally bring inflation under control through sustained monetary tightening. The process was painful, involving deep recessions and high unemployment, but it ultimately restored price stability and laid the foundation for decades of economic growth. Today, policymakers have at their disposal a wider array of tools and a deeper understanding of the inflation process. The importance of central bank independence, transparent communication, and coordinated policy responses is now well recognized. Nevertheless, the fundamental principles remain unchanged. Bringing inflation down requires a credible commitment to price stability, a willingness to make difficult decisions, and a recognition of the trade-offs involved. In practice, the appropriate mix of policies will vary depending on the specific circumstances facing each economy. In some cases, demand-side measures may be sufficient to bring inflation under control. In others, supply-side reforms or targeted interventions may be necessary to address underlying structural issues. The speed and magnitude of policy adjustments will also depend on the severity and persistence of inflation, as well as the broader economic context. Ultimately, the goal is to achieve a stable and predictable environment in which businesses and households can plan for the future with confidence. Low and stable inflation supports investment, protects the value of savings, and promotes sustainable economic growth. While the path to achieving this goal may be fraught with challenges, the experience of recent decades demonstrates that it is both possible and essential. In conclusion, reducing inflation is a complex and multifaceted endeavor that requires a coordinated and credible response from both monetary and fiscal authorities, supported by structural reforms and effective communication. Monetary policy tightening, through higher interest rates, serves as the frontline defense against runaway inflation by reining in demand and anchoring expectations. Fiscal discipline ensures that government actions do not undermine these efforts, while supply-side policies address the root causes of inflation by boosting productivity and efficiency. Managing expectations through transparent and consistent communication helps to prevent inflation from becoming entrenched and facilitates the adjustment process. Each of these pillars is necessary but not sufficient on its own. Only through their combined and coordinated application can inflation be brought down in a manner that preserves economic stability and supports long-term prosperity. As the global economy continues to evolve and face new challenges, the lessons of the past and the tools of the present will remain indispensable in the ongoing quest for price stability.